Hey everybody, Smart Silver Stacker here. Welcome to another live stream. We got some weak economic data today here in the US, and the effect that it's having on the price of gold and silver, well, is very notable. And we're going to examine this data. We're going to take a look at what is happening with the price of gold and silver today. And I also want to kind of contrast this to what we witnessed earlier this week with the release of the hotter than expected CPI data for January. So do me a favor, if you can hear me loud and clear, put a 1 in the chat, and let's get right into this data. So we got retail sales here posting the steepest decline since March of 2023. So the US consumer coming under some pressure here. And this is very important. We're going to talk about why. Now, the price of both gold and silver catching a bid on the release of this weak data, and that's critical to the dynamic that we're witnessing in the gold and silver market, especially for what we're going to see moving forward. The retail sales, they fell 0.8% in January from the month prior. That's compared to an anticipated 0.2% decrease, so much weaker than expected. Also, they revised down the number from December, which was a 0.6% increase. Surprise, surprise, that was overstating the strength of the U.S. consumer. Also, in addition to a weak U.S. consumer, we have got U.S. manufacturing dropping significantly. Now, this headline out of Reuters really cracks me up. I mean, as frigid weather depresses U.S. manufacturing output in January, manufacturing output dropped 0.5% last month after an unrevised 0.1% gain the prior month. The Fed attributed the decline to winter weather. Yeah, it's not the hollowing out of the U.S. economy by failed economic policies and central planning. No, it's the cold weather in January. Nobody anticipated that. That is what is leading to this surprise decline in U.S. manufacturing. Production at factories fell 0.9% on a year-on-year basis. Now, today, again, we are seeing the price of both gold and silver catching a bid. Silver more significantly than gold here, up 2.32%. Earlier in the session, it was actually up a bit more. So anybody who bought that dip following the CPI release earlier this week, I think did pretty well. And don't forget, if you want to buy some gold and silver, check out SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, I want to talk about the weakness in U.S. consumers here and why this is so important for what the Federal Reserve is going to do next. Now, keep in mind that, when we had the CPI released earlier this week, it was hotter than expected, and the Fed tells us, or markets anticipate that this means the Fed is less likely to print. They're going to have to push off their planned rate cuts. They're going to have to do that later because inflation is just too hot for them to begin cutting. But the thing is that what we're witnessing now is inflation is remaining a persistent problem, as indicated by the hot CPI, and yet you're beginning to see economic weakness. So what we have here is stagflation. You have a slowing economy with persistent inflation. And we know when push comes to shove, if the economy threatens to collapse, the debt-addicted economy that we exist in, which cannot really withstand these high interest rates that the Fed has imposed, well, the Fed's going to bail out the economy at the expense of the U.S. dollar, very likely. This is the GDP report for the fourth quarter and year 2023. Now, this strong economy that we've been told about by our leadership, by the political elites, by the central bankers, we had an increase in GDP of 3.3%. The increase in the fourth quarter primarily reflected increases in consumer spending and exports. So the U.S. economy, U.S. GDP is something like 68% consumer spending. This is a real problem, especially during an election year. The real economic weakness is beginning to show here. Now, let's talk about this. This is the report from the U.S. Bureau of Labor Statistics on employment cost from December 2023, and it says the 3 months period ending 2023, wages and salaries increased by 0.9%. Now, at the same time, you've got this report from the New York Fed on the household debt and credit. This report tells us that credit card balances, which are now at $1.13 trillion outstanding, increased by $50 billion. That's 4.6% over that same time. So any increase in consumer spending was being driven by two things. One, it is higher prices due to persistent inflation. And then also, it's being driven by an expansion of consumer debt. In one quarter, credit card balances rising 4.6%. I mean, annualize that, and you can see just how fast consumer debt is exploding. At the same time, we're hearing from the New York Fed that credit card and auto loan delinquencies are beginning to rise. So, consumer spending beginning to weaken in January. And think about that. In January, consumer spending fell, even though inflation was moving up faster than expected. So that means people are now beginning to buy less. Maybe they're maxing out their credit cards. Maybe they just don't have the ability to borrow anymore. So, what do? Well, you start buying cheaper things. You cut back where you can. But that's a real problem in an economy that is primarily driven by the consumer. They need consumers to get out there and borrow, to get out there and spend. But that's not going to happen as we are seeing credit card and auto loan transitions into delinquency are rising above pre-pandemic levels. That's according to economic research at the Fed. This signals increased financial stress, especially among younger and lower income households. Now, that's important because those are the sectors of the economy which come under the most pressure from rising inflation. The wealthy don't tend to be as affected by rising inflation because it's the increase in the cost of basic living that really starts to put pressure on these consumers. You can see here credit card debt, annual change, $143 billion. That's against a total of 1.129. Think about that. That's almost a 10% increase. Actually, it's a greater than 10% increase year over year in the amount of credit card debt that consumers have. And also consider that all of this new debt that is being taken on is at near record high APRs on these credit cards. Also, you have got, as we said, delinquencies rising. Credit card debt delinquency rising in Q4 2022 from 4.01% to 6.36% Q4 2023. Auto loan debt also on the rise. And these are kind of the subprime sectors that you're going to see these defaults on first. Eventually, those in the middle class and upper middle class are going to begin to feel this as well. Year over year, the total delinquency increasing from 1.03% to 1.42%. This is a number that is going to continue to skyrocket. Now, we've looked at this before. This is a chart. This only goes up to, Q3 2023. They're going to update this soon at the Fed. But the point is, one of the things that Powell and the president have both commented on when questioned about rising delinquencies, they say, well, it's still close to pre-pandemic levels, which it is, I suppose. If you look at Q1 2020, you had a 2.66% delinquency. Q3 2023, 2.98%. But if you take a look at this chart, which reflects the percent rate of change year over year, you can see now delinquencies, even in Q2 and Q3, are rising at some of the fastest levels on record. Now, the Fed is going in, think about it. It's an election year. You've got consumers who are coming under a tremendous amount of pressure. We're only in February. There's going to be a lot of pain for consumers here moving forward. The Fed is going to get out here and slash rates. I wouldn't be surprised if before the election we see some kind of vote buying. I mean, there's going to have to be a crisis before that happens, before new stimulus checks roll out. But that would not surprise me one bit if we see that. So, let's talk about what's happening with gold and silver. Gold and silver rising on this weak economic news today. So you've got this dynamic whereby inflation is rising. That makes people say, oh, the Fed's not going to print. But then you get weak economic data. Well, now you see investors taking the other approach that, well, this means that more printing is guaranteed. And we got a preview of what is very likely to come last March when the banks started to fail. I mean, the Fed jumped in there. They opened up the BTFP. They combined forces with the Treasury and the FDIC. They made sure that there was no spreading contagion. That's exactly what we're going to see this year whenever the bubble pops. I don't know when that's going to be, but the signs are there that is on the way in the form of slowing manufacturing, a slowing U.S. economy, and a weakening U.S. consumer. Now, I want to shift gears here a little bit and talk about something else that's been in the news. You might have seen this. We've got this story about a national security threat, Russian nukes in space. Okay, you've had big headlines about this going out yesterday. I mean, it turned out to be kind of a bit of a nothing burger. But I just want to point out, it's an election year. The scaremongering tactics are in full effect, and we are being geared up for a global conflict. Do not mistake this for anything else. Just, creating boogeymen out there, getting everybody riled up, getting the population conditioned for a major conflict, which is coming. Also, we had this story: blast hit a natural gas pipeline in Iran, and an official says it was an act of sabotage. So maybe we haven't launched airstrikes into Iran yet, but this could be cyber warfare, could be on the ground sabotage. We don't really know yet, but I would not be surprised if Iran is looking to retaliate for this following this attack on their infrastructure. It wouldn't be the first time that the Iranians have been on the receiving end of a cyber attack. You had the whole Stuxnet thing between the U.S. and Israeli intelligence services, and this very well could be something similar. So also, just a sign that escalations abound. We're headed towards global conflict, and you can expect more escalatory retaliations on the part of Iran for this. All of this, of course, is ultimately going to contribute to the real reason that the Federal Reserve is going to be forced to print the massive and growing U.S. national debt, $34.232 trillion now, record deficits, $1 trillion in interest on this thing, $1.5 trillion annual deficit, probably going to be much worse than that, especially if we end up becoming embroiled in a true global conflict. So, look, bottom line here is get ready for growing conflict. Get ready for the Fed to print. The U.S. economy is not as strong as we are being told. Yeah, inflation is going to continue to rise, but that's not going to stop the Federal Reserve from printing enormous sums of dollars. The dollar is likely to be sacrificed on the altar of inflation. When will that day come? That's anybody's guess. Very difficult to time these things, but it's basically just mathematics at this point that such an event is inevitable, probably sooner rather than later, given the fact that we are in an escalating global conflict and an election year. Just my take on things. Let me know what you think in the comments down below, everybody. Stay safe and happy stacking. Thanks for watching. I'll catch you next time. Smart Silver Stacker, out.